Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Today's podcast is sponsored by Global Financial Data. We've been using data series from GFD for almost 10 years, ever since I wrote my first white paper. The data has been super useful in other areas like creating CAPE ratio calculations. And for over 20 years, Global Financial Data has been aggregating and transcribing data from original sources, which no other data provider has done before. Please have a look at their website at globalfinancialdata.com for more info and to set up a trial account. If you mention that I sent you, they're offering a 20% discount on all new business subscriptions. Again, that's globalfinancialdata.com. Hello, podcast listeners. We're extremely lucky today to have one of my favorite people on the planet on the show, Steve Sjuggerud. Welcome.
Thank you, Meb. Thanks for having me.
So I'm here looking at your Skype photo, and it's a picture of you surfing somewhere. Do you know where this photo is from, by the way?
No, I don't know what. It might be a picture from Nicaragua, but I don't know the picture that you're looking at. But
okay.
Yeah, I've been fortunate to surf all over the world.
We'll come back to surfing later because that's a topic I know that's dear to your heart. And interestingly enough, thinking back, I think I met you it's coming on almost 10 years ago now, when Steve sent me an email here in LA. Steve, you remember the first time we met up?
Absolutely, yeah. Meb, I was a huge fan of your work. Basically, I felt like you were going down similar roads that I was going down on research, but you were quite frankly doing a better job at it than I was. So I felt like, man, I really need to meet this guy, Meb. And I had a window of opportunity to meet up with you in LA, but then the window started shrinking and shrinking. I was supposed to meet with our friend Van Simmons at about the same time, and then another good friend of mine moved out to LA the same moment, and so I said, Meb, I'd love to have dinner with you or catch up with you, but my only window of opportunity is with a 60-year-old guy and a 19-year-old guy, and are you up for that? And to my shock, you were on board, and we actually had a fun night that night.
I love meeting interesting people, and you couldn't have asked for a more eclectic dinner. And so we had Van on the podcast last week, which was a really fun one. And Van lives in this museum in Long Beach of amazing collectibles. You could just walk around and spend hours in there. And then, of course, there's some 19-year-old world-class surfer. And I remember sitting down because I just met Steve, listeners, and he said, hey, I'm going to be in town. By the way, I mentioned your book. This is the first book, Ivy Portfolio. And about a day or two later, I look up on Amazon and the book was sold out, which doesn't really happen on first prints for books. Usually that's a very rare scenario. And for the life of me, I couldn't figure out what it was. And I said, it couldn't have been that mention of that guy that it said he's going to be in LA. Anyway, so we meet up, sit down with Steve. I said, Steve, what are you doing in LA? He says, oh, going surfing with Laird Hamilton. I said, oh, of course. Well, that sounds obvious. But so Steve, for those who don't know, is a macro guy and a writer and a long-time writer. Been doing it for, Steve's has got to be since what, the late 90s?
Yeah, 1996, I started writing an investment letter, and
give us a little background on how you kind of came to what you do now. So get a little Sjuggerud history.
Absolutely, yeah. So I went to college at University of Florida at age 16. I ended up studying finance, and long story short, by age 23, I was vice president of a global closed-end mutual fund. And I'd done a lot of different things. I'd been a broker specializing in international stocks for a while, international stocks and bonds. And while I was a broker, I saw that a lot of my clients were reading these horrible investment newsletters. And And I couldn't believe that these intelligent people were relying on such basically horrendous advice, and all of the cliches about the newsletter industry were even worse in the mid 1990s. So I think I was 24 years old, and I said to my girlfriend at the time, who's now my wife, I laid out 5 investment newsletters of the most popular ones on the pool deck at her apartment complex, and I said, I think I can do this better than this, and I'm not sure what better means, but I'm going to go for it. And it's kind of a strange dream for a 24-year-old to say, this is what I'm going to do, but I got a job. The idea was that I could reach a lot more people and give them a lot more useful investment advice by writing an investment newsletter. And shockingly, 22 years later, we're still doing it, and Porter and I have become one of the biggest in the world, if not the biggest in the world, at doing this thing, just by trying to treat people the way that you would want to be treated if your roles were reversed. So that's kind of the story.
And that's sort of, people vote with their dollars, right? And, yours, Steve writes a publication called Daily Wealth, or True Wealth. There's 2, one's monthly, and we've been a paying subscriber for a long time. It's a macro focus. So Steve, why don't we talk a little bit about how you think about investing? So despite the fact you guys have an enormous global audience of subscribers and readers, a lot of our audience may not be familiar with your work. Why don't you talk a little bit how you think about investing, and then we'll start to move on to some more specific themes and the way you see the world today.
Absolutely. Meb, I think you and I became friends because we are 2 of the only people that we know who actually believe in both looking at value and in looking at momentum in the uptrend. And I've kind of joked that I don't have a lot of friends in the investment world because the value guys wonder how the heck could you look at that momentum stuff, and the trend-based guys wonder how the heck you could look at the value stuff. But you're one of the rare guys like me that actually are interested in both value and the trend. Basically, what I've written to my readers for many years is that I look for 3 things in an investment. Ideally, an investment could be cheap, hated, and in an uptrend. And what I've found is that you can apply this basic criteria, cheap, hated, in an uptrend, to all different kinds of asset classes, stocks, bonds, real estate. You can even take it somewhat into currencies, and the same things apply across them. You just have to figure out, how do you define hated? How do you define cheap in each of these different asset classes? But I think that's one way that you and I became quick friends, was that.
And was this something, a lot of people, you talk to value guys or trend guys, and there's this sort of aha moment in the beginning. A lot of people sort of, like, whether it's politics or religion or anything else, they come to their worldview early and then they kind of stick with it. How did you kind of come around to this sort of framework? Was it trial and error? Was it years of trading? Was it something where you just from day one kind of gravitated towards it? What was kind of the process to arriving at how you look at the world today?
Yeah, I think it's a great question, because in school you're basically taught, at least when I was, efficient markets, value is all that it sort of matters, and so I was coming. It had been ingrained, kind of beaten into your head that value is what matters and the trend stuff is irrelevant, and so that's where I started out in the world. But then when I started actually crunching numbers for myself, darn it, the thing that actually worked over and over again, I couldn't make momentum not work, if that makes sense. Like, it always won. It was always so it was like, it was an evolution. It wasn't that I woke up one morning and said, well, this has to be the way it is. It evolved. Porter Stansberry probably doesn't want to hear me say this, and he writes my paychecks, but you're probably in the same camp with me, that if I had to choose between one or the other, I would actually choose momentum over value. And I know that's going to cause at least 50% of your listeners to howl, but
I actually agree with you. And I think that, we had Wes Gray on the show, a professor at Drexel, studied under Fama at Chicago, and he kind of arrived at trend following from the same sort of perspective, namely, through and through Chicago classic style efficient markets, and then with some value sprinkling in, and also, but has really come to understand and appreciate momentum. And one of the kind of irrefutable parts about it is there's been a lot of research that just continues to come out in the academic community. The classic paper that really defines sort of this area is an AQR paper, Cliff Asness, called Value and Momentum Everywhere. Yep. And, many people tend to think just in terms of stocks or maybe in global stocks, but really it's an investment framework that if you apply to currencies and commodities and stocks and everything, you can really apply the same thing. And then there's been a lot of other people that have published on it too. So starting with that framework and how you look at the world, again, I've been reading your stuff for 10 years, but a lot of people haven't. What's sort of the way the world looks at you today? I know a recent piece you did in the last few months was something along the lines of a transcript or a playbook for the Trump market. And Steve, to his credit, and I actually tweeted this certainly in the last year or two, but I said, you've been one of the most consistently bullish people on U.S. stocks, maybe with Richard Bernstein. There's not that many more that have been consistently bullish for years now. Most people either got out in 08, 09 and never bought back again, and a lot of other value crowd says, no, it's way too expensive, the GMOs of the world and all these other shops, and not giving them a hard time. They stick to their process. That's great. But tell us a little bit about what's the kind of the way you see the world today.
You mentioned GMO briefly. I'll just say something about Jeremy Grantham. I mean, it was incredible what he said in 1999, 2000 about at the peak. He really called the peak, nailed it, and then he nailed the bottom in 2009. It was pretty incredible. So I don't want to give them too much of a hard time because they did have some really great major calls. But so for me, what I want to do is find there are always 100 reasons why you could sell or not buy. But I want to find the one compelling reason, the overwhelming thing that is going to affect the market, and which basically causes all of the other reasons to be almost not valuable. And so the thesis that I had early on, and Meb, this is basically that, and I've been writing this for many years, essentially that interest rates would stay lower than you could imagine for longer than you could imagine, and that would drive asset prices like stocks and house prices higher than anyone can imagine. And that has been the thesis that I've stuck with for many years, probably since 2009, 2010, that rates would stay lower than you could imagine for longer than you can imagine, and that would drive asset prices like stocks and housing higher than you can imagine. And the thing is that the first part of that has been correct, and yes, we've been in a 7-8 year bull market here, but we still haven't reached the point in my mind where asset prices like stocks and housing are truly higher than anyone can imagine. And I'm so, Meb, even though I've been bullish all these years, I'm actually still bullish. Basically, if it ain't broke, don't fix it, right? We are getting stretched. Let's call it the 7th or 8th inning of this great bull market, but the biggest gains often happen, and you know this as well as anyone, the biggest gains often happen in the final innings. And I think that NASDAQ 1999 is a great example of this. The last 6 months of the dot-com bull market were where the biggest move happened, and it was an extraordinary move. And so even though stocks have gone up a lot, there's still a lot of pessimism. Basically, individual investors don't fully trust it yet. And so until they do, until they're on board, the peak isn't here yet. So my core theme that I've actually had all of these years is still in place. And my current theme is really this idea of a melt up. And I like using the phrase melt up, the term melt up, because it implies a meltdown may follow. And I do think we could have a melt up like we saw in the NASDAQ in 1999 or in house prices, a decade ago. Where things just completely go off the rails, and there's no foundation to reality, to any sort of value whatsoever. I think that's where we're headed. We're not there yet, and so But like I said, cheap hated, and in an uptrend, we have our uptrend. The market's relatively hated. It's not free for sure, but as you know, bull markets don't die because of valuation.
Yeah, it's funny is that, so I remember watching a presentation you gave, and I don't know how many years ago, let's call it 2 to 5 years ago, and Steve is spot on, gives literally the same presentation about here's what's going to happen to U.S. stocks. And this is what happened, right? So they've had this kind of trudging bull market higher. And after the presentation, I said, Steve, good talk. And Steve said, Meb, nobody cares. And It was really funny because the audience didn't. The audience was like, all right, we don't want to hear this. We want to hear, here's why stocks are going to crash, or here's why XYZ is going to do this. And Steve just said, look, this bull market has a lot of room to run, and here's why. And so it's funny to watch because I actually just recently saw the American Association of Individual Investors sentiment survey, and it's still, the bull percentage is incredibly low. It's at like 26%, which is a super low reading, and the bearish reading is actually pretty high. So despite the fact that we're in year 8 bull market, usually you don't see the sentiment being that low, but it's kind of this general malaise or don't care or kind of, I don't know the right word to describe it, but you don't have the euphoria. That's for sure.
Yeah, here's a fact. I know you like to look at numbers like this. So over the past 4 weeks, I don't know if you saw this, the net outflow out of equity mutual funds and ETFs was $21 billion, which is a massive number. I mean, this is not what the peak of a bull market looks like. This is not euphoria at all. Now someone may ask, well, Steve, value is, clearly we're at a high in valuations. But one point that I want to bring up and stress, or just kind of have people think about, is sure, we're at a high in valuations, but we're also near all-time lows in long-term interest rates. I'm sure your audience, Meb, realizes that assets, you don't just choose assets in a vacuum. For example, what I mean is, let's say that U.S. stocks are paying an 8% dividend. Well, that sounds great. That sounds like a great value. But in 1980, if short-term rates if you can get 15% on a CD or 8% in a dividend, are stocks attractive at that point? What I'm getting at is relative to interest rates, every asset that you're buying is relative. The value is almost relative to something else. You're choosing what to do with your money, and you have to choose relative to other assets where the value is, people that are forced to invest every day. Even though dividend yields are low, even though valuations are high, relative to bond yields, do you want to buy high yield bonds today? Where is the value? Where are you going to put money to work today? And I think when you can buy the world's top companies, many of them at valuations, forward PEs in the teens, when the bond yield is so incredibly low, I think the value is there. When you look at Japan, when it soared, interest rates were so incredibly low, and that was kind of the fuel for the outrageous valuations in Japan. I mean, there were other factors, of course, but I just wanted to point out, if someone's saying, well, gee, why would anybody buy stocks at today's current valuations? You've got to realize that valuations are really all relative, and you've got to look at what you can get for your money elsewhere.
And, you and I have both done this research where you kind of chop the stock market into 4 quadrants, whether it's cheap and expensive markets, and uptrend and downtrend, and we always say that the highest historical returns have come from cheap in an uptrend, but second is expensive in an uptrend, and that's surprising to a lot of people that the second best returns come from an expensive market just getting more expensive. So what are you looking for? Are there any classic signs for you that there's either warning signs or time to get out of stocks? Is it simply trend rolling over? Is there anything in your playbook that you would start to look to give kind of yellow flashing light?
Yeah, no, it's a great question. I mean, we're nowhere near that point yet. What I would like to do is to ride this as high as possible. I think it will go much higher than anyone can imagine. And then I will actually use trailing stop type things to get me out. I think there's a great Soros quote. I'm going to mess it up, but you basically want to know what you want to know the enemy. You want to know what's going to hurt you. And we know that this isn't going to last forever. I'm not drinking the Kool-Aid of the .com stocks or whatnot. I know that I'm going to get off the bus But so what I want to do actually is over the next month, we're going to put together a report that's basically our 4 indicators of the peak and how we'll know we're at the peak. I mean, right now we're just a long way from it, and I know that feels crazy to people who say, "How can we look at an 8-year bull market or whatnot and say that this thing can't be near its end?" But Meb, I don't know if you know. I remember reading Vic Sperandio early on. Did you ever read Vic Sperandio stuff?
Trader Vic, of course.
Yeah, Trader Vic.
Wasn't
exactly.
he one of the original market wizards or second round of market wizards?
Yep. And I remember reading his stuff, and this was many years ago, but he did something. He basically said that a bull market had an age; it had a lifespan. And it basically he looked at the length of every bull market and said that basically gave a probability of the market continuing to go on. And of course, this idea of a lifespan of a bull market, it blew up on him in the 90s. You know, I mean, the bull market just kept going higher and higher and higher and higher. And there were a couple other guys that did this type of work too. And the 90s taught me that was all wrong. There is no official length of time. It is when all of the factors that you and I, you know, when the euphoria is here is when the ultimate peak is in place, and we're a long way from that.
And I think that's, you know, you can flip that too, and of course true on the downside. I mean, how many value investors have you seen go out of business or have massive drawdowns because they say, here's a country or a sector or a stock that can't go any lower, and then it continues to go lower and lower and lower. So the same sort of thing. There's never necessarily a floor as well as a ceiling on a lot of investments. All right, so bonds aren't that attractive. I know you use commitment of traders a lot in some of your analysis.
I do. You know, you said bonds aren't that attractive, but we're actually long treasuries. We've been long treasuries for 2 months and making great money on it, but I'm probably going to close that trade out pretty soon. So it was really high yield bonds that I was specifically saying, you know, the spreads are just incredibly narrow, and what's your risk versus your reward there? It's not very sexy.
Yeah, but so is the thesis on the treasuries? Was it because they just moved too far in one direction? Was it because can you explain what a commitment of traders is for people?
Yeah, I mean, in the shortest description, I guess, it is what it sounds. It is the commitment of big investors in the futures markets. And what you look at is which way they've committed their money. Are they long or are they short? And I think what we saw in the Treasury market was it was clear that the Fed was saying, we are going to raise short-term interest rates in this year, and we are going to be on a consistent path of raising short-term interest rates. And so the futures bets, I mean, this is a simplified explanation, but futures traders started betting that interest rates on bonds would go higher, and the bets reached an incredible extreme where everyone was betting on higher interest rates I don't remember right now if it was a record extreme or a decade or multi-decade extreme. But whenever you see these extremes, you're often very close to a turning point, and if you can just wait for the trend to confirm your idea that this extreme, when everyone has bought something, there's nobody left to buy, right? I mean, that's the simplest idea. Or if everyone sold, the opposite. So in the case of treasuries, it was really a sentiment trade. We just saw an extreme where everyone said, well, gee, if the Fed's raising rates, treasury rates have to go up too. I mean, there were other factors, you know, the Trump election and optimism and this and that. But so we entered the trade, and it's actually been a great trade because who would bet on lower interest rates when the Fed is saying we are raising interest rates? And we did, and it's been a great trade for us. But yeah, I like to look at commitment of traders as a sentiment example, but only when the commitment of traders reaches an extreme.
And with treasuries, we've done some studies here too, but investing when 10 or 30 years are in large drawdowns or high percent drawdowns has actually historically been a great trade, for a year on out to get high treasury returns. And that was a setup that coincided very much similar with what commitment of traders was saying, in that you can bet at times for treasuries to mean revert when they've had a pretty nasty period. We'll link to that in the show notes if I dig it up. So before we move on to kind of foreign investments, which we'll talk about in a minute. You've talked a lot about housing and whether that's single family homes and how to get exposure to that asset class, as well as actually, advising investors over the past 7-8 years as this is one of the best times to invest in housing, as well as buying a house or even speculating on land. I think you even bought some land in Florida. Why don't you tell us a little bit about your thesis on housing and update it to kind of where we are today?
Yeah, I mean, for me, what I like to invest personally in are what I call fat pitches. It's where you can. There's no way to go wrong in it. And in 2011, I bought some land in Florida, like you said, as an example. The property was previously under contract for $14.4 million in 2009. I offered $750,000 on it in 2011. The bank that had been foreclosed, the bank that was stuck with it, countered at $900,000, and I took it. So in 18 months, this property lost essentially over 90% of its value. That was never going to happen. That was basically a market with no bid, the housing market in Florida at the time. And so I invested personally aggressively in Florida real estate. And those times are obviously gone right now. Florida real estate is back in a big way. But what's missing from Florida real estate, and I'm using Florida real estate as a proxy for the nation, but Florida's where I live. What's missing here is housing supply. And basically, the housing starts are nowhere near where they need to be to equalize supply and demand. And it's not just a Florida story. If you look at the national numbers on housing supply, housing starts, basically, we are not starting enough homes. And again, this is economics 101. What happens if there's not enough supply to meet demand? Prices go up, of course. So in my, like I said, you want to just break it down to the simplest factor, the most important thing. And right now, nothing's in people's way of buying a house. I mean, mortgage rates are low. People can get a mortgage if they need it, but there's no supply. And so I think and you can't believe, I live near Jacksonville, Florida. I think on Zillow, you could take a look, but I think the average or median, whatever Zillow uses, is about $140,000 for the average Jacksonville home, which is probably a 3-bedroom, 2-bath house with a 2-car garage and a yard. And you travel anywhere in the world. I was in Beijing, and if you want an apartment in Beijing, you'll get a dump for $1 million. And Hong Kong's more than that. Vancouver, you can't get anything for less than $1 million Canadian in Vancouver. So when you look at U.S. home prices, it's no surprise why foreigners are buying here. Why I see there's still plenty of upside. I think California might be a different story for you, Meb, but the rest of the nation, I think, is still an incredible value. Maybe we're in the say 5th or 6th inning of that, as opposed to it's not the beginning, but it's not the end for sure.
It's very localized, like you mentioned, and so we've had Jared Dillian on the podcast who talked a lot about Canadian real estate bubble, and you see things like the euphoria where you're not seeing here, and certainly not in stocks, but having lived through enough bubbles, and you as well, I'm sure the signs are familiar. I mean, he was just sending out a tweet about Canadian get rich real estate conference headlined by Tony Robbins and Pitbull. And by the time Tony Robbins and Pitbull are doing a real estate get rich conference, that's a coincident sign that things are crazy. We're a little frustrated because it has gone crazy here where we live in Manhattan Beach, California, and we have a standard office here. We're budget guys, we're value guys, and I'm laughing because there's a open house tonight for what we call it our kind of dream office. It's right on the pier, overlooking the surf, but was listed at 3 times what we pay now. Wow. And so it sat empty for a year, and then where we are in the cycle, someone eventually picked it up, which was just a dagger in my heart because I, like you, was putting in these low balls. So there's definitely landlords and realtors around the country that probably hate Steve and I, and just people on Craigslist in general, because I was putting in low balls to this landlord every month. I said, man, this is empty. come on, you're just burning money. And then someone eventually came and paid for it. And the worst part about it now is that the company that moved in and that is having the open house tonight is also named Cambria.
That's funny.
It's a granite tabletop company. The only beauty, though, is that the Cambria, they have huge signage everywhere, and they sponsor like almost every sports event in the country, so they must be doing well. But it never says what their company is. So hopefully we're just getting a little name recognition in town now. Everyone's say they think that's our Cambria. And when they fold and move out, hopefully we'll take over the office to keep the signage.
Yeah. Exactly.
So, real estate's interesting. And so you've mentioned, I know in the past, some sort of mortgage ETFs as a way to play it, as well as some of the single family stock companies, whether it's been, gosh, I'm trying to remember the name, Silver Bay or Two Harbors. Are those a couple of them that are plays?
Yep.
Okay, so moving on from housing and thinking about that, spoken from a happy renter, by the way. Let's move on. So I'm looking at your current recommended list, and of the 15, 20 odd positions, there's some very common themes, and one of the biggest common theme is foreign equities. And finally, this is a world where it looks to me like the value and trend is lining up. We've been talking about foreign stocks for the past 4 years about them being cheap. But until really last summer, maybe, kind of when interest rates bottom in the US, you hadn't seen the foreign stock outperformance. Why don't you start to tell us a little bit about your thesis on why there's so much in the kind of foreign space, and then we'll drill down a little more specific into a couple areas that I know you're very bullish on.
Yeah, I mean, I think it's a simple story, and Meb, you do this work literally as well as anyone on earth. But I mean, look, emerging markets, what is it, 7 years of flat performance or something? I don't have it in front of me. Versus the S&P's almost straight vertical performance. I mean, the outperformance of the S&P or the underperformance of emerging slash foreign is incredible, and so obviously it creates some value. It creates a degree of hated's not the right word, but just people have just given up. They've just thrown in the towel. And a lot of times ignored is even better than hated, just because absolutely no one's even thinking about it. Meanwhile, this is the growth engine this is where, you're going to see faster growth in these countries than you will in the U.S. For sure. And so there are moments. I started out specializing in foreign stocks as a broker, and I started in 1993, and I think Mark Mobius's Templeton Emerging Market Fund went up 100% that year, and it was just euphoria over emerging market stocks, and it seems to come and go, and people think China's going to take over the world, and then people forget about China completely. People think Chinese stocks are great and you have to own them. People think there's no reason that you would ever own them, and you just kind of end up kind of playing that love and hate, that bipolar investor opinion on these things, because the countries don't change so much. It's the investor sentiment that changes, and so if you can just play that a bit, you can actually do extremely well.
Well, let's talk about China, because I know you've spent a ton of time in China, traveling there. I think you're going there again this summer. I've actually never been. I've been to Hong Kong, but I don't know how much that really counts. But you spent a lot of time in China, and it was maybe last year or even 2 years ago where you and I were speaking at a conference, and you pulled me aside. We were sitting by a cocktail reception, and you said, "Meb, I want to talk about this story. I'm really excited about this China story. So why don't you tell the listeners a little bit about what you told me then, and kind of what you've learned since, and what your thesis is on China?"
Yeah, so China is an incredible opportunity. It is one of these fat pitches, and I've only had a few of them in the last decade, like 2 or 3. So there are so many opportunities. I think the story that I may have told you was I went to my first meeting, and I just realized that China was actually so far ahead of the States in one particular area, and I didn't see it coming. But a woman was doing everything on her phone, and literally everything. And the guy that we were traveling over there with said, "Steve, do you have WeChat yet?" And I said, "WeChat?" He said, "Yeah, you'll need it. It's kind of like Skype over there. You'll need it." And I said, I don't need a messaging. I don't need Skype. I mean, but then I learned very quickly that if you want to call somebody on the phone, you don't call them on their phone number. You reach them by WeChat. It's almost like a Facebook Messenger thing. Was my first thought of what this was. But then I later understood that the people of China, basically in 2 years, their entire life moved from sort of the way we live now to having everything on their phone to a degree that we can't even fathom here in the States. 900 million Chinese use WeChat, and 50% of them use it for 90 minutes a day and send 75 different WeChat messages a day. So it is completely taken over China's lives. But the WeChat does so many things. One of the very unique things and very interesting things that really Facebook hasn't, or no one in the States has really implemented, is a payment system where instead of paying with dollars or paying with your Visa card, you actually just kind of zing people money by WeChat, and people prefer to pay with their cell phone than any other means. And so, like I said, I was in this first meeting with a major sort of mutual fund company in China, and I asked the woman, the chief investment officer, if she actually used cash or a credit card for anything, and she said that she only uses her cell phone. She doesn't carry a purse. She doesn't carry cash. I said, "Is there anything in this world where you don't use just your cell phone for?" And she said, "My parking lot attendant only takes cash, and every month I berate him to start taking mobile payments." And it was just an entire revolution in China that we can't even fathom here in the States. And so to me, I came home thinking that, wow, the parent company of WeChat, which is called Tencent, is actually going to become the world's largest company. So that's one theme of this that kind of blew my mind, and it's quickly starting to happen here, more so in the States. So one theme in China is really this, they're ahead of us, shockingly. It took no time at all, and they do not want to use money like we do, or use a cell phone like we do. They're not tied to their old banking system or their old phone provider. They don't use the mobile network like we do. They want to use Wi-Fi and just contact you on WeChat. If you're in a taxi, the taxi has Wi-Fi, and you can talk on WeChat to business contacts. I mean, anyway, that's just one little slice of what's happening in China. From an investor perspective, it's incredibly exciting. First of all, it's super cheap, but there are two actual catalysts that are once-in-a-lifetime opportunities. So the short version of why they're cheap in a sentence is that the Hang Seng China Enterprises Index, which is the major Chinese companies, it's at a forward PE of 7 and 1 times book value. So that's about as cheap as anywhere on Earth, and these are some of literally the world's largest companies in this index. So Chinese stocks are incredibly cheap. Those are the ones that are the ones I mentioned are Chinese stocks listed in Hong Kong. But there's a much bigger story going on that shockingly, no one is talking about. And Meb, you will know this story better than most, but I think that hardly anyone is up on this story. And it's the basic idea that, look, China is the world's second largest economy. And when you add up the Shanghai and Shenzhen stock exchanges, China is the world's second largest stock market. Now, where in the global stock market indexes are the Shenzhen and Shanghai stock exchanges? Where is China's stock market in the global indexes? Meb, what percentage of the world index? If China is the second largest country in the world, what percentage of the world index is made up by local Chinese stocks?
You're saying what should it be, or what is it?
What is it? What is it now?
I think I already know the answer, but it's basically nothing, right?
That's right. It's nothing. So you have the world's second largest economy, the world's second largest stock market, the A-share market for Chinese stocks, and 0% of them are in the world indexes. Now, what do you think the likelihood that will continue? What do you think the likelihood of that is?
Same number, 0.
Yeah, I mean, yeah. So here we are. We have a one. What if I just if I just said to you, Meb, look, the world's second, let's say it's not China. Let's say it was Germany is not in the global indexes, Meb, but it's going to be added, and Germany's going to make up, 15%. We'll just make up a number. And so Germany's going to go from 0% of a global index to 15% of a global index. So then what would happen to German stocks?
Well, I'll give you, they're going to go up a lot. And I'll give you a great example is that anytime things get added to the S&P. So if you remember when Berkshire got added to the S&P, it went up like 15% before it actually got added. So as every tracking index had to start buying it. And that's actually the dirty secret of indexing is a lot of names that come in. Once they get added, there's a lot of run up to that period. So yes, I would think German stocks would go up a lot.
Yeah, well, I mean, we're not just adding one stock to an index. I mean, we are adding the entire market to a major index. And it's not just, emerging market indexes need this, China indexes need this, world indexes need this. It is going to be a movement in the hundreds of billions of dollars into Chinese stocks. And the thing is that people are going to have to buy them. ETFs, index funds, anybody tracking, MSCI emerging, anybody tracking this stuff, whether or not Chinese stocks are a good value, these funds are going to have to own these particular stocks. So my suggestion, my fat pitch, is get yourself there first. And thankfully, we can actually get in incredibly cheaply right now. So this is a once-in-a-lifetime opportunity. You know that hundreds of billions of dollars are going to flow in. Now, look, it's not going to happen in a day. MSCI recognizes that, this is a dam that needs to burst. And what they'd rather do is let the money trickle in. But I think over the course of roughly 5 years, it'll go from no stake to its full stake in these indexes. So you have a 5-year, few $100 billion tailwind as you're buying one of the planet's cheapest markets.
Let me give you an interesting data point. And I remember talking about this on Twitter. And so this is a couple years ago. This is the end of 2015. And I was tweeting about China, and I said, this is the cheapest the stock market been in a decade. And I just started getting the nastiest responses and emails as a sign of people really hating Chinese stocks. But if you go back, and then I eventually posted a chart of 10-year PE ratios on the China stock market, people forget that in the mid-2000s, when everyone was clamoring for emerging markets because they'd been outperforming, so all the money was chasing it. All the stories were about how, all the same data points we have today, but that emerging markets were growing faster, that they're a huge portion of world population, that the BRICS were emerging, and China and India specifically. Well, China got to a PE ratio of 60 in 2007. And so that's a legit bubble. The US only hit 45 in the late 90s. Japan hit the highest we've ever seen, which was in the 90s and in the 80s. But so China hit this huge value. And so it's taken them forever to work that off. But I tweeted and I said, hey, look, 2007, China hit a CAPE ratio of 62. At the bottom in 2009, it hit 17, so back to normal price. In 2013, it hit a low of 12, but still it had only increased to a value, and this is in 2015, of around 15. And I'd have to check what it is today, but I know it's in late 2015, it hit a value of around 12. So I know it's in the low teens, but it just goes to show when you're talking about sentiment, there's a lot of positives lining up on this trade, which are all the positive demographics and economic side, but also that it's not particularly liked. It's kind of in this hated category where I get flamed if I tweet about it.
That's great. I love it.
So it's a long-term play. So how do people go about it? Do they... I know you've talked about the Crane shares funds in the past. What are some other, what's the way to place this trade? Is it through ETFs?
Yeah, I mean, it's a challenge. you and I can't easily buy A shares ourselves. And man, I think the right way to do it, you mentioned Crane shares. The Crane shares guys have been out in front of this, and they actually created an ETF that holds what will be bought by all of. So this is the word front running is might be the wrong word to use. I don't know if it is or not, but I mean, if you want to get out ahead of this trade. Crane shares actually. So what happened was MSCI came out with essentially their roadmap to inclusion is the word they use, and to me, a couple years ago when they put this out, they actually gave the specific allocations of the stocks. So to me, I don't know, Meb, if you're a bit younger than me, did you ever see the teacher's manual when you were growing up in school where it had there's your textbook, and then there was the teacher's edition that had all of the answers?
That's right. I haven't even thought about that. The same textbook, and then the answers were usually in red.
Yeah, exactly. So not only do we have the textbook, but MSCI had actually put out the teacher's edition. And I don't know if this was on accident because they don't have it in their current versions of the inclusion stuff, but they actually gave you, the teacher's edition, the actual answers as to what their allocations were going to be. And Crane shares built an ETF, not on what the allocations are looking backwards, but what they will be. And it's KBA is the symbol of that one. And so to me, that's the simplest way to take advantage of this particular trade. But I also like, that KBA is the symbol of the ETF. But I actually just like owning even FXI. Simple FXI is a great... is a great way to play this as well. And I know that sounds funny, but so what FXI is, it basically holds the Hong Kong listed Chinese blue chips. And these are the behemoths of China. And Tencent's the top holding, and China Construction Bank, and really massive businesses. But these are all still part of the inclusion process. These are going to be the benchmark stocks of China. And there's a weird thing, Meb, I'm sure you're aware of it, but the AH premium. Are you familiar with the AH premium?
Yeah, but why don't you explain it to our listeners?
Yeah, so this is crazy, and Meb, I'm sure you'd agree. So in China, in the A shares, the identical company, literally everything about it is the same. The stock is identical, trading in Hong Kong and trading in China. And right now, the AH premium, as it's called, is at about 20%. So the same identical stock trading in China is 20% more expensive than that stock trading in Hong Kong. The identical shares. And so by buying FXI, you're buying these same identical stocks, but you're buying them at a huge discount. I mean, when do you get a chance to buy global blue chips, legitimate stocks at 20% discount to their other holdings or whatnot? It's to the identical shares. So you would think that there would be some sort of arbitrage happening in these shares, and that arbitrage, in my mind, to me, this is the biggest anomaly in finance, and it will go away soon. So you can buy KBA as a way to play the A shares, but FXI actually holds many of the same companies that are going to be part of MSCI's inclusion. They just happen to be the Hong Kong listed versions of the identical stocks. So we can buy them at a discount there. I'm just throwing that out as an idea. Very simple, very common way. That might be easier for if some of your listeners are fund managers or something, might be easier for them to get through their investment committee to buy something like FXI.
And aren't you getting ready to go back to China this summer?
I am, yeah. I mean, it's I just the opportunity is too extraordinary, and I'm killing a bunch of birds with one stone there. I feel like I want my subscribers, my customers, to actually see what I saw for myself with WeChat and with sort of the technological revolution, because when you see it for yourself in China, you see what's possible here, and then you reach basically this new sort of thesis for the U.S. that basically we're going to enter a world where there's only a couple companies that matter, and I realize that sort of Facebook Facebook and Google and Amazon and these sort of masters of the universe already seem like they've soared so much, and how much more can they soar? But what you see in China is, for example, there is no room for a Pepsi. Like WeChat had that, it's Coke or nothing. What I mean by that is WeChat, there is no second place. No one wants to be on a separate network. Does that make sense? Like no one. So, and so just like in the States where Google has 77% of global market search, global internet search, and Bing has 7%. There isn't room for second place. Facebook, who wants to be on a different network than Facebook or Instagram or obviously there's Snapchat and such, but the point is that these companies like WeChat in China, and I just fully, I got it in China, is that Facebook and Google are able to gather such an incredible amount of information about you and me for free, and then they can use sort of machine learning and artificial intelligence to absolutely make the most out of that data set, whether it's serving up ads for you and making more money off ad revenue to selling the results of their data, for a variety of different reasons. So my trip to China actually reinforced that if we have this melt up, as I've described it, Meb, I actually believe that these big tech names will be big winners in the melt up, even at their current valuations. I think there's still room for them to go much higher. So I didn't mean to get off of the China theme, but
no, that's good. I mean, it's people talk a lot about the first $1 trillion company, and usually the names bandied about are Apple and Amazon and everything. So it'll be interesting to see if it ends up being a Chinese tech company or what it might be. I wanted to touch on one more thing before we start to wind down. I mean, we've burned through an hour almost already. This could go on forever, which is great. I know you think a lot about real assets and commodities, and over the years have recommended, investing in various ways, whether it's been actually gold coins or through the St. Gaudens or through even positions, recently, such as, miners or gold shares. What's your general perspective on real assets? Is it the same exact framework you're looking for? Is it slightly different, and kind of the role that they play in a portfolio for you?
Yeah, I know that it might make some gold bugs mad, but it's just another asset class. It's just another one to find sort of cheap and hated, and in an uptrend. And it was funny. I was asked to speak at Rick Rule's big Sprott natural investing symposium in Vancouver last year, and I stood up on the stage. It was late July into July, and I think I might have been the first speaker at this conference, and I first thing I said was, I told everybody in the room, I just sold all of my gold stocks yesterday, and so basically it's like being at church and telling everybody there's no God or something. It was people couldn't stand it, but it was exactly the right thing to do. I mean, I nailed the peak in gold stocks, but before then, in about January, I'd never really bought gold stocks in my career personally, which sounds crazy from a newsletter writer, right? But I'm just looking for a great value, a fat pitch, an extraordinary moment, and I hadn't seen that extraordinary moment until sort of January of 2016. I bought heavily, and then I sold heavily in July. Haven't really been back that much. I mean, it was an extraordinary. It's just another asset class. I know that I've done a lot in collectibles and a lot in all kinds of things that normal investors aren't looking at. But it's really just trying to find another great value.
I was thinking, because I had Van on last week, and we were talking a lot about rare coins and ideas, and it's not an area that I've really spent much time with historically, but I chatted with Van to get a starter allocation up and running. But so he was talking a little bit, and I see kind of, you've mentioned, and I may pronounce it wrong, St. Gaudens, is that how you say it?
Right, yep.
MS65, and you've talked about that as a way to play gold, where these coins traditionally have a premium to kind of the melt value that in bull markets with gold can get really high, but right now is at one of the lower premiums in a while. Can you talk about your thesis there at all?
Yeah, absolutely. So what I'd like, and as any good investor, you would like to have limited downside, and if there's a way to improve your upside but keep your downside the same, I'm interested. And so, with gold and with St. Gaudens coins, they are at their record low premiums relative to the price of gold. So what happens is if gold goes down, the St. Gaudens coins go down by about the same amount. So you have a 1-for-1 on the downside. Does that make sense?
Yep.
But on the upside, we've seen these particular coins rise. Hundreds of percent, even 1,000%. So it's really just just the idea of having limited downside, unlimited upside. So, for example, an MS65 St. Gaudens coin today sells. It depends on a couple things, but let's say it's around $1,800. It's not a huge premium over the price of gold, but they are premium coins. They are rare, and these coins could rise dramatically based on if they do anything like they've done in history. So what I like about them is they sort of have 1-for-1 downside, basically with the price of gold, but you have multiples on the upside. It's almost like a leveraged ETF where you get double long upside, but your downside is 1-for-1. So
I wonder if you couldn't structure a trade, and I'm just thinking out loud here, and I don't know anything about this area, where you buy a basket of these coins. So let's say you buy $1 million of these coins, and with the knowledge of the trade thesis you just outlined. And I wonder if you couldn't short out some of the exposure to the price of gold through the futures, because the gold curve, to my knowledge right now, is in contango. So if you shorted the 2017 or 2020 gold futures, you would get a roll down in yield, a roll down in price. So you would get a positive roll yield from that investment. And so, or buy, I don't know what the options would trade at, but you could buy puts options on the future. I wonder if there isn't a way to structure that trade where you would have potentially even more limited downside to the price of gold, but a high multiple expansion to the it's kind of like almost like buying a free call option. We may have to do some work on that. My thought was, I think it's an interesting idea, but then you're just only exposing yourself. It's a great idea, but you're only exposing yourself to the upside of the coin. And I'm not calling myself an expert on the upside of the coin, but if I want to be long gold, this is an interesting way to do it, where it could go 1-for-1 upside, but it could go 2-for-1 or 3-for-1 on the upside. So I would rather still maintain my exposure to gold in the coin. Does that make sense? Yeah, absolutely. All right, sorry, this is a random tangent. We'll have to do some work on that and report back, listeners.
No, but by the way, you talked absolutely. I'm glad I was able to introduce you to Van all those years ago. There is nobody that's more of a walking encyclopedia of how to make money in alternative assets than that guy. And I hope that you were able to learn something from him. The stories that he tells.
I learned something from Van every time I talk to him, even when he stopped in just to say hi for dinner when I was out with some friends the other night, and we started talking about pocket knives, and probably would have talked about an encyclopedic knowledge of pocket knives for about an hour. But yeah, Jeff, my co-host, and I are going to head down to Long Beach probably next week to make some initial purchases of some coins for my starter collection. So we'll post those as the show notes when we pick them up.
Awesome.
Let's start to wind down with a few shorter questions. And speaking of collectibles, I'll have one more real quick one before we get into the shorter questions. Some of your passions that don't have anything to do with markets, speaking of a collector, talk a little bit about what you collect some interesting objects, both in the surf and music scene. Are there any in particular items that stand out in your mind?
A lot of times there are some great stories. Just where it came from, and a guy that owns a music store not far from here. He said, Steve, he knew the guitars that I liked. He said, Steve, this guitar can't. He said, he's a legend. He did some guitars for Eric Clapton and Keith Richards, and super legendary guy. And he said, Steve, you got to get down here. And he didn't tell me what it was, but I knew it was going to be something important. And basically, I ended up buying a guitar that came in from a little old lady I paid $30,000 for it, and the guy couldn't believe I paid $30,000 for the guitar. And then I owned it. It was a Larson Brothers guitar, which most people aren't familiar with. But and then it was in such perfect condition that I didn't even want to play this darn thing. So I ended up selling it through Gruen Guitars in Nashville for $72,000, I think. Where these things come from and the stories of how you end up acquiring them and what you end up doing with them. It's been a fun ride learning about collectibles, but I've also learned, and Meb, I'm sure you can appreciate this, on liquidity and illiquidity. And one of the things that I really love, for example, about timberland is I feel like you get paid a massive yield, but you're buying illiquidity. And I thought for a while that by buying illiquidity, I was buying higher yields. Does that make sense? I don't know if you... And but I learned through buying particularly illiquid investments cheap is that you still need to find a buyer, And so one thing, if anybody's considering getting into collectibles, whether it's sports cars or whatever it is you don't necessarily want, if you're really going to buy it with the intention that someday you're going to sell it, you really need to buy something that someone else actually wants. It's a crazy thought, but for example, if there are 30 Mercedes Gullwings, for example, then there's a known market for the Mercedes Gullwing, and there's a known buy and sell spread. But if you have the prototype, to me, that sounds sexier. Like, wow, not only, this is before the 30 that everybody's aware of, but the way collectibles markets work, it's pretty strange that the prototype may be worth significantly less than the ones that everybody's already familiar with. And even though it may be cooler to you or me, the collectibles markets don't work that way. They want illiquidity. They want familiarity. But for me, going back to what I've done, I've built a collection of some of the finest vintage surfboards, starting from the ancient, the early Hawaiians up to present. And man, it's just really, the stories are extraordinary, but I don't know how interested investors would be in them. It's a lot of fun. But it did teach me lessons for the financial markets. Like, for example, with timberland, where buying illiquidity isn't necessarily a path to higher investment returns.
I have a great example of illiquidity sitting in my driveway right now. If any of you listeners want to buy a 1967 Toyota Land Cruiser, that is also a good example of money pit investments, restoring vintage cars or boats. Those are kind of the opposite end of the old 80-20 rule, but it's a lot of that.
That's a cool car, man. Have you thought about, have you seen the Icon? Isn't Icon out in...
the Icon. So I had mine restored by the same company, which is in the Valley in Los Angeles. And the Icon, for listeners who don't know, that's kind of a from scratch restoration of a Land Cruiser FJ40, which is the Jeep body style. They go for like $150,000, and so that is and believe me, I about once a month search the internet for used Icons for sale, because, like I said, I'm a cheap bastard and would love to put in a low bid. But mine is kind of the similar, has old Corvette engine and modern components, but unfortunately, I think it's run its course as a Faber investment.
Okay,
but I love it. I only drive 2 miles to work anyway, so there's not a whole lot of driving going on.
Sounds cool.
You've been writing for almost 2 decades now. What has been your most memorable investment or trade in that period? You can take some time to think about it, and it could be a good trade, it could be a bad trade, but is there one that kind of jumps out at you?
I thought you might ask, what was sort of my worst trade, but you're too polite for that. But
no, you can ask that too.
That's what came to mind. So, I mean, this was. I'm going to share my worst trade. I mean, I've had a lot of successful trades, obviously, but my worst trade, it was buying Putin had come out and said that I am not going to bankrupt Yukos. I have no intention of bankrupting Yukos, the big oil company. What he wanted was to put Khodorkovsky, the outspoken leader of Yukos, in prison. And he did. He made up some bogus charges and put Khodorkovsky in prison. And he came out and said, I have no intention of bankrupting Yukos. And Yukos was trading at like 2 times earnings. And I don't mean like 2 times earnings. It was trading for 2 times earnings. And so what's your downside in buying, one of these massive Russian oil companies at 2 times earnings when the president, the only guy who would basically say the only guy who had an interest in bankrupting Yukos says, I'm not going to bankrupt Yukos. So what I did, Meb, was I trusted a politician. And fortunately, when we bought the stock at 2 times earnings, no kidding, I put a 50% trailing stop on this. I said, I thought there's no way this is going to happen, but it is a Russian stock. It could be extremely volatile. We put the widest stop I've ever put on anything, which is 50% on Yukos. And sure enough, Yukos went right to 50%. We stopped out, and I said, I felt terrible for my subscribers, felt like I'd let them down, and how foolish was I to trust the words of a politician. And Yukos actually, it went all the way. Putin bankrupted Yukos. That may be the most, it may not be the most memorable, but is surely impactful. And I think you probably learn more from your losers than your winners, right? Because you dig in and say, what did I do wrong? And so I think that one's a good one for you.
You know, it's funny. It's a question we don't give the podcast guests ahead of time. If they listen to our podcast, obviously they would hear it. But it's so funny because you ask if you're like, what's your worst investment? Almost every person, there's this pause and then almost just this like sigh, right? There's just this visceral feeling of pain. I mean, I can think back to my worst trades, and anyone who's been through it, you learn that's a very physical experience, the real physical pain of losing money or doing something really stupid, and it sticks with you. And hopefully, listeners, you make those mistakes when you're young and don't have any money or not with much money, but it's something that's probably the most useful educational tool out there, rather than the opposite, which is getting really lucky when you're young and then making the dumb mistakes later. Steve, on one kind of related question, and then we're going to wind down. What, for someone who's been interacting with hundreds of thousands of subscribers over the years, if not millions, and a lot tend to be individuals, what kind of advice would you give to the listeners of this podcast that you kind of sees the common mistakes that most of these investors make that would probably be easy to correct if, I know you mentioned trailing stops, but what would kind of be your advice that's reflective of, the feedback you get from subscribers over the past 20 years?
I mean, it's really always the same thing, and it's that individual investors let their losers ride and cut their winners. And it's shocking that it's so challenging to learn. The best thing I can do when I hire new people is to tell them, don't open an account, because basically they need to learn what's right and know it down in their bones before they start trading, because as soon as people start investing their own money or trading and they don't already have this idea of don't let a small loss become a big one and don't cut your winners early, I would say that's the biggest thing that individual investors have a hard time with, and it's crushing. Meb, we're looking at China. I don't mind. Look, China rose by triple-digit percentage gains 3 separate times since 2006. So there is a strong likelihood that China, starting at a single-digit multiple on HSCEI, there's a strong likelihood that sometime in the next 5 years, we're going to see a triple-digit gain in China. Let's say that you buy today and you cut your loss at 15% or something if we're wrong. And then you buy again and you cut your loss again at 10% or something if you're wrong. And then you buy a third time and you make 150% gain so what we did there is we cut our losses early and we let our winner ride. And that is the correct way, in my opinion, and in my experience to make money. But most of the biggest problem is letting small losses become big losses. Even in the case of that Putin example, I cut my loss at a massive 50% loss. You say, geez, I'm already down 50%. Why don't I just see how this thing plays out? And but we live to fight another day. So I hope that answer is.
No, I mean, I think it's a perfect example, and I think it's great advice. Is the most important lesson in investing and trading is simply survival. And so many investors, they have a stop loss. It just happens to be zero. And so,
right.
The behavioral research shows, it's exactly, and you could just walk people through this example. They buy something at 100 and it goes down to 80 and you're saying, that's stupid. I should have waited a month. And then it goes down to 60 and you're like, I'm an idiot for listening to my broker friend. I'm going to sell it when it gets back to 80. And of course, what does it do? It goes down to 40. And you're saying, you don't even open your statements. You just don't even think about it anymore. You're pissed off, and it goes to 20. And then at that point, you say, well, there's no point selling it now because what's the point? I've lost most of my money, and then it goes to zero. And so you've started to see, by the way, over the past few years, a lot of research on individual securities come out. Longboard did this originally, and I know Goldman and JP Morgan, and then there's an academic paper recently about the distribution of stock returns. And so it's something like 2/3 of stocks underperform a broad index. Roughly half of stocks have a zero rate of return, and it's something like 20% essentially go to zero. And these aren't microcaps. This is like Russell 2000 wow. Biggest stocks in the US. But the very small percent, and this is one reason why indexing work, and another reason why trend following works, is these big winners make up for all the losers. But it also goes to show why stock picking is so hard, because the chances are, you're going to pick the losers and the really bad losers. So having the stop loss on all those stocks or investments that may do poorly and letting the big winners ride. And we'll post these in the show notes because these are some of the most important studies I've seen. I think that's just a statistical verification for what you're talking about right now.
Yeah, I mean, I think my personal outperformance comes down to a few great, a few great winners that I actually let ride, and the rest of it is kind of treading water. And if you never let yourself get those few great winners, you are not going to outperform. Yeah, I mean, chances are you're going to underperform. So.
I was looking at the Stansberry Hall of Fame trades, and you're sitting on top with number one. Is probably because the rest of the guys would have sold those big winners when they hit 100, 200%. But knowing you, it probably was a trailing stop loss.
Yep, that's exactly right. It was. I think the stock was up like 1,300%, and we had a 25% trailing stop on it, and we pocketed a 995% gain.
Oh, that's
and that
funny.
was after giving back some. So
that's funny. Steve, this has been a blast. If listeners want to follow you in your research, where do they go?
I mean, the easiest thing is dailywealth.com. It's free, and there's a huge archive over many years of free, good stuff. You'll see Meb's name in there a lot. And check out dailywealth.com.
Great. Look, Steve, it's been a blast. I'm looking forward to catching up with you again sometime soon. In the coming years, we'll have you back on the program to see how this whole China story is playing out.
Yeah, we got to get you in the water one of these days here, Meb.
My surfing is so relative to simply who's nearby and drags me into the water. I actually just went to Hawaii a few weeks ago, about a month ago or 2 months ago, and have some local friends there that took me out to some of the local surf breaks, and I was out of shape and pathetic, and I'm a terrible surfer anyway. Great skier, terrible surfer. But
no, it takes a long time to learn. But man, I'm glad you just get out. It's extraordinary, all the things that you manage to squeeze in your busy travel schedule and all the extraordinary work you're doing. So
surfing is a great humbling.
Absolutely.
It's a great idea if you think your poo smells rosy, go surfing or do something like that, and you get humbled pretty quick. What's the? I meant to post this on Twitter, but we had one request was said, ask Steve what the largest wave he's ever been on.
Man, it was probably in Fiji. And we were staying at Tavarua and Namotu, and the pros were towing in the day before. It was too big to paddle in, but maybe a couple times overhead.
That's a couple times too big for me.
Yeah, I got held down that day pretty good, and a severe hold down, as you can attest, Meb, is it'll shake your confidence. I mean, I got held under for a long time. You're supposed to relax, as you know, right? When you're getting tumbled by the whitewater, and I relaxed and relaxed and relaxed and relaxed, and the whitewater wasn't letting me up, and so in Fiji you can actually open your eyes. The water's so clear, and look around, and I got pushed through the reef, and I'm looking in all directions, and it's all kind of clear. So I take 3 or 4 strokes with my arms, thinking I'm headed towards the surface, and I don't think I'm any closer to the surface than I was before I took those 3 strokes, and I'm out of air. My calves have actually locked up, and I take 3 more strokes, still not at the surface. I've finally surfaced, of course, and but that was it for that day. It was
makes my palms sweat just listening to that.
I mean, it's fun to challenge yourself, and it's a real joy to, instead of just go to the gym or something, to challenge yourself mentally and to see if you've got the guts to go for it and such. But
I usually don't. I'm like a waist high surfing sort of guy. I'm happy to take our Costco Wave Storm out and cruise around. That's like by the way, listeners, that's like the best purchases. I think it's like $100 or $200.
Yeah, it's just $100. Yep, and it is the best purchase. Yep.
And it's funny because you see down in Manhattan Beach now, you see a lot of some of the best surfers. I mean, I'm sure they're just playing around, but out ripping around on these wave storm boards. So there's no stigma to riding one of these. I love it.
Yeah, just get out there. This morning, I took 2 of my newer employees out to surf. There was one of them's first time, and yesterday was the other one's first time. And they were both out of gas almost instantly, but they were in heaven. One of them's from Colorado. He'd never surfed. The other one's from Chicago. They don't have any familiarity with the ocean, but it's just brings joy in so many ways. And in 20 minutes, they were done, and we were back in the office. So life's
watching someone's face on the first wave they get set up. I actually tried to buy some surf lessons last night at a silent auction, and I lost because we're trying to get my co-host Jeff out in the water, and he's afraid of the sharks. So we'll get him out one day. Is the Sjuggerud model coming to life? Wasn't there a surfboard you were gonna have coming out? At some point?
Starboard, which is the leading stand-up paddleboard company, did make a Steve Sjuggerud model Pro XL. So it's funny because you met Sean Pointer, who's their superstar, 2-time world champ, and so they have all these world champs with their pro model, and then somehow there's this old guy from Florida who has a pro model, which makes no sense, but it was kind of them to.
People may start buying it. They're just gonna have trouble pronouncing the name on the.
That's right. That's right.
It must be a cool model if it has this many letters.
What it was, the story is I convinced them that, like, look, you make all these pro models, but all these guys weigh 140 pounds and nobody can actually buy a pro model. Why don't you make a pro model that actually normal people can surf? And they said, yeah, will you help us do it? I said, absolutely. And so that's where the Pro XL model came in. So you don't have to be 0% body fat to use a pro model. You can use my model.
That's awesome. Steve, it's been a blast. Thanks for taking the time out today. Listeners, thanks for taking the time to listen. We always welcome feedback and questions for the mailbag at feedback@themebfabershow.com. As a reminder, you can always find the show notes and other episodes at mebfaber.com/podcasts. You can subscribe to the show on iTunes, and if you're enjoying the podcast, please leave a review. Thanks for listening, friends, and good investing.
Today's podcast is sponsored by The Idea Farm. Do you want the same investing edge as the pros? The Idea Farm gives small investors the same market research usually reserved for only the world's largest institutions, funds, and money managers. These are reports from some of the most respected research shops in investing. Many of them cost thousands and are only available to institutions or investment professionals, but now they're yours with the Idea Farm subscription. Are you ready for an investing edge? Visit theideafarm.com to learn more.